Hi, and welcome to this guide on tax obligations of commission agents.
If you are a commission agent, there are essential tax information you need to be aware of, such as determining who is a self-employed person, the tax obligations of a self-employed person, what is the tax treatment of commission agents' business income and expenses, what are the GST obligations of a commission agent, what do you need to take note when filing your income tax return, how to keep proper records for your business. What are the tax obligations to take note when you are in receipt of rental income? The types of actions taken on non-compliance on tax matters, and how to disclose reporting errors.
There are different types of self-employed person, as can be seen from the characters shown. As a commission agent, you are considered a self-employed person if you are carrying on a business or vocation. Let's meet David, who is exercising a vocation as a real estate agent. A few others such as Elaine and Samuel are also considered as self-employed since they are carrying on a business as a sole proprietor and as a partner. What are the features of a self-employed person? Generally, a self-employed person is under a contract for service. For instance, in David's case, he works for himself and is in a position to realize a business profit or loss. David is also responsible for the cost of expenses incurred in the course of his business. He may make investments in equipment, such as a laptop required to do the work, and retains a right over the use of the asset. He provides his own medical and insurance coverage. He is usually paid on a per-job basis. David is financially liable if the obligations of the contract are not fulfilled. He may hire employees to run his business as shown, and hence, he has to pay them and incur business expenses. Other business expenses may include rent relating to his office space. In summary, all of us have to comply with the income tax laws. As law-abiding taxpayers, the self-employed persons need to be aware that they have to keep proper records and accounts of their business transactions for 5 years. By maintaining proper records, they are able to file their income tax returns by the 18th of April of every year without delay. During the filing, they need to ensure that the figures reported in the tax return are complete and accurate. As a self-employed person, you are required to make compulsory contributions to your MediSave account if you are a self-employed person and you are a Singapore citizen or permanent resident and your net trade income is more than $6,000. The amount of compulsory MediSave contributions that you have to make will be stated in the Notice of Computation of CPF Contributions from IRAS. Do contact CPF Board directly if you need assistance on payment matters. For more information on MediSave contribution rates and sample calculations, please visit the website stated here. As a commission agent, you will need to report all gains or profits derived from your business or provision of services as trade income. You can claim business expenses against your trade income, subject to some deductibility rules. Commission agents may receive incentives from their commission-paying companies either to motivate them to excel in their work or reward them for meeting certain sales targets. As these are tied to their performance, they are taxable as gains and profits arising from their trade, business, or vocation. To assist commission agents in understanding the tax treatment on the different types of incentives, we have provided a list of questions and answers in our website. You may wish to access the FAQ by scanning the QR code stated or follow the URL shown. There are a few common types of income received by real estate agents such as co-broke fees, referral fees, and bonus commission. Please note that all these income are taxable and hence need to be reported in their tax returns. For expenses to be tax deductible, they must be related to his business. In other words, the expenses must be wholly and exclusively incurred in the production of David's income. For instance, David needs to rent an office space in order to carry out his work duties. Therefore, the rental fee incurred is related to his business. The expense must be incurred during the basis period in the production of the income. Taking the previous example, David needs to ensure that the cost incurred for the rental was during the year 2020 in order to claim for it in the year of assessment 2021. A good way to support this is to retain documents relating to the rental fees paid. Lastly, the expense must be allowable according to the tax laws. In David's case, the rental fee paid met all the three criteria, and he can claim it as a business expense. Here are some other examples of allowable business expenses. They include employees' remuneration, taking public transport, and business entertainment. For more information on allowable expenses, please visit the website as shown. What are the type of expenses that are disallowed for tax deduction? Firstly, expenses that are capital in nature are disallowed. For instance, David purchases a laptop to be used in the course of his work. He cannot claim this as an expense as this is a purchase of fixed asset which is capital in nature. However, he may claim a capital allowance on such a cost. Expenses that are personal and private in nature are not tax deductible either. Let's say, David purchases a new pair of shoes, a few shirts and pants. He wonders whether he is able to deduct these expenses against his business income as he wears them for his work too. In this case, the costs incurred for these purchases are personal and private in nature. They are not allowed for tax deduction against his business income. Lastly, there are expenses which are specifically prohibited by tax laws. For instance, David uses his car for business meetups. He would not be able to claim for private car-related expenses such as parking fees and fuel costs as these are specifically prohibited under Singapore's tax laws, even if the car is used for business. Some other examples of disallowable business expenses are gifts to non-customers, fines for breaches of law and entertainment expenses for family and friends. For more information on disallowable expenses, please visit the website stated here. Let us now take a look at some common errors made by agents when claiming deduction against their business income. Please note that expenses incurred to purchase food for own consumption and your medical fees are private in nature. They are not allowable for deduction against your business income. Only expenses incurred solely for business can be claimed as tax-deductible expenses. Do not claim estimated or unsubstantiated expenses. All expenses claimed should be based on actual amounts incurred and supported by source documents. It is incorrect to claim excessive payments made to related parties, such as family members who are hired to help in the business, that are not in line with the market rate. Some commission agents may have the misconception that excessive payments can be claimed in view that there is an employment relationship, and/or payments are indeed incurred for business. The correct amount to be claimed should commensurate with the actual services or duties performed that is in line with the market rate. Let us now take a look at some case studies to test our understanding of the topics covered. Scenario 1. David spent $40 for a dinner with a client at a restaurant. He kept the receipt and claimed the full amount as entertainment expenses. Is this correct? Let's take a few seconds to think of the answer. The answer is a no. The cost of the meal for your own consumption is considered as a private expense and hence not tax deductible. In this example, David can only claim $30 as his entertainment expense. As part of proper record keeping, you should record the details of all your entertainment expenses incurred for your business as shown in the record sheet. Scenario 2. David drove his car to meet a client. When he returns to his office at the later part of the day, he estimates the expenses incurred on his car for the trips made and recorded them as transport expenses. Is this correct? As usage of public transport is strongly encouraged in Singapore, expenses incurred on using private car are specifically prohibited for deduction under Singapore's tax laws, even though the car is used for business purposes. Therefore, David should not be claiming these expenses against his business income. Scenario 3. David pays his niece a monthly pay of $5,000 even though she only works for 4 hours per day as a part-time admin clerk for David. The amount paid by David to his niece is excessive and does not commensurate with the level of services performed by her. Can he claim the full sum as deductible expenses? The amount claimed by David should commensurate with the actual services performed by his niece, that is in line with market rate or industry norms based on her scope of duties or working hours. David could ask himself if the amount paid to his niece is reasonable as compared to a third party with the same qualification and experience performing the same type of services.
Now, let's go through a brief introduction on the GST obligations of a self-employed person. Commission agents must register for GST on a compulsory basis if their taxable turnover is more than $1 million at the end of the calendar year, or is expected to be more than $1 million in the next 12 months. If you are not liable for GST registration, you may choose to register voluntarily, after carefully considering the obligations and responsibilities of being GST registered. A commission agent is required to compute his or her business taxable turnover to determine whether he or she is liable for GST registration. A sole proprietor must combine the turnover from all his sole proprietorship businesses and income derived from any trade, vocation or profession. The GST registration will be in the name of the sole proprietor. For a partnership, you must combine the turnover of all partnership businesses, with the same composition of partners. Each partnership business that is required to register for GST, will be separately registered, under its own name. Once your partnership is GST registered, all businesses with the same composition of partners, need to be GST registered. This includes businesses with the same composition of partners, which you may set up in the future. The business taxable turnover for a company is based on the turnover for that single company. The GST registration will be in the name of the company. Once you are GST registered, you must charge GST on your services. If your services are in relation to a local property, this would include any incentive fees, project commissions and commissions received from developers. If your services are in relation to an overseas property, the supply can be zero rated, as it will qualify as an international service. In addition, referral fees received by a GST registered commission agent are also subject to GST. This includes referral fees from banks or renovation companies. If GST is not charged on the commission or referral fees, it will be treated as inclusive of GST. You will have to account for GST on the commission or referral fees received using the tax fraction. In a co-brokering arrangement, both agents must charge and account for GST on their commission received, if they are GST registered. In this example, let's assume a seller has contracted A to help him sell property. B helps A to find a buyer. Both A and B have agreed to share the commission of $9,000 payable by the seller, in the ratio of 60-40. A is making a supply of service to the seller. A is required to charge GST on the full commission of $9,000 received from the seller. B is making a supply of service to A. B is required to charge GST on the 40% commission of $3,600 received from A. If you are in the business of selling or leasing properties, you will be required to account for GST on the following transactions. 1. The selling price of non-residential properties. 2. The rental from the lease of non-residential properties. And 3. The selling price or rental collected from any sale or lease of furniture and fittings in residential properties. Upon deregistration from GST, if you have claimed input tax on the GST incurred on the purchase of your non-residential property, you have to account for GST at the prevailing GST rate on the open market value of properties still held by you. This must be accounted in your final GST return, F8. Generally, GST-registered commission agents may claim GST incurred on their business expenses. Here are some examples of commonly claimed business expenses. In addition, commission agents who are in the business of selling or leasing of self-owned non-residential properties can claim GST incurred in relation to the purchase of the property as input tax. The input tax claimable includes the GST incurred on the purchase price of the property, furniture and fittings, maintenance and service charges, renovation and repairs, and conveyance fees. As a GST-registered business, you are required to file accurate and correct returns. We have published a series of videos on common tax errors made by businesses. Please scan the QR codes to watch the videos. We have briefly covered the GST obligations of a commission agent. We would like to encourage you to go through these additional resources for a more in-depth understanding on how to meet your GST tax obligations.
Now, let us look at a few important pointers on filing of income tax returns. Regardless of the amount of income received by you, you must file an income tax return if you receive a letter, tax form or an SMS from IRAS informing you to file your taxes. If you did not receive the notification or income tax return from IRAS, you must also file a tax return if you were in receipt of an annual income, including other taxable source of income, for example employment income, rent, exceeded $22,000 or your annual net business income exceeded $6,000. You can request to file tax by activating your MyTax portal account at IRAS website by the 1st of March and e-file your tax return at MyTax portal from the 1st of March to the 18th of April. As a commission agent, please declare your commission income under the section Trade, Business, Profession or Vocation of the Income Tax Form B. You are required to report your trade income using a 2-line or 4-line statement. Please note that there is an increase in revenue threshold of 2-line statement from $100,000 to $200,000 from year of assessment 2021 onwards. If you received revenue of $200,000 or less, you are required to report only the 2-line statement which comprises the items revenue and adjusted profit or loss. If your revenue exceeds $200,000, you are required to report a 4-line statement which comprises the items revenue, gross profit, allowable business expenses, and adjusted profit or loss. If your revenue exceeds $500,000, you are required to report a 4-line statement and also submit a certified statement of accounts. Certified means signed by the sole proprietor or precedent partner of the business, indicating that the accounts are true and correct. For more information on 2-line or 4-line statement, please visit the website stated here. From year of assessment 2015, commission-paying companies can submit the gross commission income of their agents to IRAS electronically. Such income information submitted by commission-paying organization are pre-filled on the electronic tax form for commission agents.
However, some income information such as referral fees from banks, bonus commission from developers may not be included in the income transmitted to IRAS. It is the responsibility of the commission agents to account for their accurate and complete tax reporting. As such, we have to ensure that the pre-filled income information is correct and declare the income from other sources which are not pre-filled.
Now let's talk about a scheme which can be useful to you. It is called Fixed Expense Deduction Ratio, which is known as FEDR in short. FEDR was introduced for commission agents from the year of assessment 2020. It is only applicable for commission agents with an annual gross commission income of up to $50,000. Should you fulfill this criteria, you can opt to claim a deemed amount of expenses based on 25% of the income. Please note that the 25% deduction will be automatically calculated for qualifying commission agents via My Tax portal. Should your business expenses as a commission agent exceed 25% tax deduction and you wish to claim the actual business expenses, you can still do so during e-filing. Let's go through some case scenarios to enhance our understanding on how FEDR can apply. This first case scenario shows the different amount of gross commission income earned by two agents, David and Amanda, in the year. David earned a gross commission amount of not exceeding $50,000, so he will qualify for FEDR scheme. He will be allowed a deemed amount of expenses based on 25% of his gross commission income of $40,000. Amanda was an insurance agent for the first 6 months in the year and switched to become a real estate agent subsequently. Her total gross commission income from both sources is $55,000. As this amount exceeds $50,000, she will not qualify for FEDR scheme and has to claim the actual business expenses incurred against her commission income.
In this second scenario, Susan earned a total of $45,000 as an agent in the year. Susan wishes to claim deemed expenses FEDR only to her income earned as a real estate agent and claim actual expenses for her income earned as an insurance agent. While her total commission income for the year does not exceed $50,000, Susan is not allowed to opt for deemed expenses claim for one of her commission income sources, and claim actual expenses for the other. She has to opt for deemed expenses claim, or actual expenses claim consistently, across the different sources of commission income earned for the year.
Here is an example of how the deemed expense amount will be automatically computed on the income, deductions and relief statement of your electronic tax form if you are eligible for FEDR. In this income declaration page, you may change the revenue amount should it not reflect the total commission income earned for the year. If the total amount does not exceed $50,000, the 25% deemed expenses option will be checked by default, and the adjusted profit or loss amount will be automatically computed. If you wish to claim actual business expenses, you should click on the Actual Allowable Business Expenses radio button and manually input the adjusted profit or loss amount. For more details on the FEDR scheme, please visit IRAS website as shown. Now, let us take a look why keeping proper records is important and ways to do it. Good record keeping means maintaining a full and complete physical or digital record of income and expenses such as invoices, receipts, proof of payments, and other documentary evidence. In line with statutory requirements, keep these records and documentary evidence for a minimum of 5 years. There is a misconception that the records and documents can be discarded once the tax bill is received. These records should be retained as IRAS may request for them in the course of audits. As a commission agent, you need to set up a good record-keeping system to track your business income and expenses from the onset for tax reporting purposes. There are many benefits in keeping proper records, some of which I like to share with you now. By having a good record-keeping system, you can be aware of the financial status of your business. It helps you make better business decisions at any point of time. These business records can be the source of evidence to detect whether there have been any business losses, internal fraud, and theft. With a proper record-keeping system, your income earned and business expenses incurred can be readily determined, thereby reducing the cost and effort for tax filing. You will also be able to produce records and documentary evidence to support your income declaration, if there are any queries from IRAS. It is highly recommended for you to keep your records digitally, as it has many advantages compared to the manual way. It is a quick, efficient, and accurate way to record the business transactions, especially relating to your business expenses. You will be able to get timely update of how your business is performing easily, so that you can plan ahead and forecast your business needs. It is a convenient way to keep the invoices, which can be easily tracked and referred to, as and when needed. It provides the ease of generating summaries and reports for the revenue, purchases, and expenses transactions, such that you can extract the figures for tax and other business reporting obligations. Keeping digital records requires lesser storage space than manual records. It will also facilitate the generation of data listings via Microsoft Excel spreadsheet format, should IRAS request for supporting records. Such spreadsheets helps expedite audit review by IRAS as well. For your information, you do not need to seek approval from IRAS to keep your records digitally for tax purposes. However, it is important for you to ensure that proper internal controls are in place to maintain the integrity, completeness, accuracy, availability, and reliability of the digital records. You need to retain all the source documents, accounting records and schedules, and any other supporting records relating to your business. Examples of source documents are receipts, invoices, bank statements, etc., as shown here. Accounting records and schedules refer to general ledger and profit and loss statement. Example of other supporting records relating to business are the business contracts. When you receive fees or income, you need to issue serialized receipts to your clients, with a carbon copy retained. You also need to retain source documents, such as the receipt books, invoices issued, agreements signed with customers in an orderly manner. Likewise, for payments of expenses, you should obtain the digital or physical invoices or receipts and retain them. In instances when a receipt is not issued, you may prepare a payment voucher. The payment voucher should state the details such as supplier's or recipient's name, date of purchase or expense incurred, description of item, and the amount. As a good practice, do make payments for expenses through a separate bank account which is used solely for business purpose.
For GST registered businesses, please refer to the topic on GST obligations of a commission agent, shared earlier.
For assets used for the business, you are required to prepare a fixed asset schedule right from the start of your business, so as to record the assets purchased. Do remember to retain the documents such as invoices. You are encouraged to maintain separate bank accounts for business and personal purpose. Keeping bank accounts solely for business use allows you to trace your business transactions easily. In the absence of separate bank accounts, personal and business transactions should be differentiable. You should retain all business-related bank statements. For more details on keeping proper records, please refer to the website stated. You may also gauge the effectiveness of your record keeping by visiting the web page shown. IRAS has further simplified record keeping requirements for small businesses to make record keeping easier for them. From the 1st of January 2014, small businesses which meet the following conditions can qualify for Simplified Record Keeping, or SRK in short. They are: annual revenue of the business should not be more than $100,000 for the past 2 financial years. With effect from year of assessment 2021, the business annual revenue is raised to $200,000 so that more small businesses can benefit from the SRK initiative.
The business assets should be less than $100,000 at the end of the latest financial year.
The business should not be an investment holding or property development business, and the business is a sole proprietorship or partnership that is not GST registered. Small businesses that qualifies only need to keep business records such as registers and listings, and not source documents such as receipts and invoices. For more information on simplified record keeping, please visit our website as shown here. Let us take a look at a case study now. After David completes the filing of his income tax return for the year, he can safely discard all the related documents and reuse the files for storing new receipts and invoices. Is this correct? The answer is a no. There appears a misconception that business records and documents can be discarded once the tax bill is received. Please note that for tax purposes, David has to retain all records and documents for 5 years. For instance, business records for the year 2020 should be retained till the year 2025. IRAS has also uploaded several videos on record keeping onto the YouTube. The QR codes and the URLs are available here. As a commission agent, you may wish to learn more about the tax obligations when renting out a property, so that you are able to share with your clients where applicable and facilitate their rental income reporting. For your information, any payments received when renting out your property are subject to income tax and must be reported in the tax return. Rental income includes the rental of premises, rental of furniture and fittings, service charges and maintenance fees of the property received from the tenant. Should there be co-owners for the property, the rental income received is taxed on all the joint owners based on their legal share in the property. These are the qualifying conditions to claim for expenses against the rental income. They are incurred solely for the purpose of producing the rental income. For example, should the door lock be faulty, the cost of repairing the door lock can be claimed as a deduction. They are incurred during the tenancy period and not before it commences or after it ends. At the same time, they cannot be private in nature. For example, property owner is not allowed to claim for utilities, maintenance paid for his owner-occupied property against his rental income from other properties. Rental expenses claimed cannot be capital in nature. For instance, if the property owner has taken up a mortgage loan for the purchase of the property that is rented out, repayments on the principal loan amount are not tax deductible as they are capital in nature. However, he can claim his mortgage interest payments as expenses against his rental income. Some common allowable rental expenses for tax deduction are fire insurance and repairs made during the period of rental. These are some common disallowable expenses for tax deduction, which we would like to bring to your attention. For more details on rental income and expenses, please visit the website stated. Since year of assessment 2016, IRAS has introduced a simplified claim for rental expenses for tenanted residential properties. A deemed rental expense calculated based on 15% of the gross rent will be pre-filled on the electronic tax form to reduce the burden of record keeping. In addition to the 15% deemed rental expenses, property owners can still claim mortgage interest on the loan taken to purchase the tenanted property. Alternatively, property owners can opt to claim the amount of actual rental expenses incurred. Should you have more than one tenanted residential property, you cannot opt for 15% deemed rental expenses claim for one property and actual expenses claim for the other. In other words, you need to apply the choice of expenses claim consistently to all your tenanted properties. Please note that simplified claim for rental expenses option is not applicable under the following circumstances. When you did not incur any kind of rental expense except for mortgage interest against the rental income, or you had derived the rental income through a partnership in Singapore, or the rental income was derived from a property held under a trust. Let us now look at two scenarios on rental income and expenses. First scenario. Ms. Grace has rented out two properties which are A and B. She made a net rental loss for property B. Can the rental loss from property B be offset against property A's net rental income for tax purposes? The answer is a yes. Ms. Grace has rented out two of her properties. She made a net rental loss for one property. In this case, she can offset the rental loss of this property against the net rental income of the other property for tax purposes. However, please note that such rental loss cannot be offset against other sources of income, such as her trade income earned as commission agent. Second scenario. Does Ms. Grace need to keep the receipts for the expenses incurred for her properties if she is claiming the 15% deemed rental expenses? The answer is a no. Since the objective of introducing the deemed rental expense is to simplify tax filing and reduce the burden of record keeping, Ms. Grace would not need to retain records of the rental expense if she is claiming only the amount of deemed expenses. However, she needs to retain the supporting documents for the mortgage interest, for example bank statements, if she is claiming it as an expense. Such documents have to be retained for 5 years as they may be requested by IRAS for audit purpose.
Next, let's take a look at the penalties for non-compliance of tax matters. Taxpayers are ultimately responsible for the information declared in their income tax returns. In fairness to the majority of people who meet their tax obligations, IRAS undertakes strong actions against small group of errant taxpayers, through detailed investigations to uncover tax evasion and fraud. There will be severe penalties for those who willfully evade tax, and IRAS will not hesitate to bring offenders to court. If you have made incorrect declarations, you can correct what you declared in your tax returns. Under IRAS Voluntary Disclosure Program, IRAS imposes reduced penalties for taxpayers who come forward with full disclosure of the mistakes uncovered from self-reviews. If you wish to disclose omissions or errors made in your past income tax returns, you can email the details to IRAS. We encourage taxpayers who have made errors in their tax returns to come forward voluntarily to correct their errors. For more information, please visit our website as shown.
Thank you.